Hello and welcome to Tax Free Weekends, an initiative by ICICI Direct that helps you plan investment in tax saving instruments. With the financial year 2021 coming to an end within a month's time, a lot of people rush up doing their last minute tax saving investments. And in this hush hush, choosing the right product from the options available becomes difficult sometimes. Today, we will touch upon ELSS, Equity Linked Savings Scheme, as a tax saving instrument. And to talk about it, I have a very special guest with me, Mr. Vishal Kapoor, CEO, IDFC Asset Management Company. Welcome, Mr. Kapoor.
Pleasure to be here. Thank you.
Financial planning is still emerging in India, sir. How crucial is it to invest with a financial plan in place, and how do one go about it?
So planning, I would say, is absolutely critical. And when we say plan, there are many things that can make up a plan. But to keep things simple, I would suggest that start with the basics, which is what is your goal. And I think if we can define the goal well, then many of the other things that are associated with a full financial plan, including what's the time horizon, what's the liquidity need, how much risk can you or should you take, what should therefore be the allocation of assets, all of those subsequent steps will become simple. So I would just suggest to most savers that just start with your goal. If you have a clear goal, then it will be easy to build a plan.
Why is it important to consider tax planning as an essential part of financial planning? Can mutual funds be the instruments of tax planning?
So, while planning in itself and the goal in itself is what one should look at, one can look at the facilities available through tax planning as almost a gift or an encouragement or an incentive that is being given to you as a taxpayer. Unfortunately, we don't have too many such gifts available from the tax department, but the ones that we have, we must certainly try and make the most of it. And in one of those incentives or gifts that are available, free, is a section which allows you to take deductions when you invest in certain specific instruments. This is a section called ATC. But fundamentally, we must know that up to 1.5 lakh rupees invested in certain select instruments are available for a tax deduction. So another way to look at it is that, if something is being given free and it's an incentive, why not make the most out of it? Within that incentive, there are options available, and certainly equity-linked saving schemes, which are offered by mutual funds, are one of the most attractive ones that I would encourage most people to consider.
What is the return potential of ELSS scheme, and why does it make sense to choose ELSS scheme for saving taxes when we have so many options available?
Right. Before we go to returns themselves, I think it's important to look at, again, the objective, which is, what does this scheme or the equity linked savings scheme or this section try and do? It is encouraging you to save for your future goals or long-term goals like retirement. So most of the schemes available within this are trying to encourage long-term savings. Now, when we think long-term, I think there is adequate amount of research data that tells us that equity as an asset class is best placed to give you attractive returns over long periods of time. Mm-hmm. So the first point is, since you're investing for the long term and that's the objective, equity becomes a very attractive asset class. And a mutual fund ELSS offers you the highest amount of equity allocation within all the schemes available within the specific section. The second is that while there is equity and there is the growth potential of equity, the lock-in period for this product is just 3 years. So after 3 years, it becomes as liquid and as convenient as any other open-ended fund. So to that extent, should you need this money, although it's kept for the long term, should you need it in an emergency, it's available without any load or charge. Whenever you withdraw, even if it is part withdrawal, you don't have to take out the entire amount. It's again tax advantage because it is taxed beneficially rather than interest. It is taxed as capital gain, long-term capital gains tax, which means that up to 1 lakh rupee, it is tax-free, and above 1 lakh rupees, currently there's a 10% tax. So it is an advantage even when you want to exit. And there are many other advantages and conveniences of mutual funds that come wrapped in because it's a mutual fund product. So it's managed by a professional fund manager. You have great transparency. You have track record. You can compare and you can track it very carefully. And the benefits of an SIP or regular investments or low amount to start with, you can get started with just 500 rupees, are additionally wrapped into this product.
Mm-hmm. Sir, can we do SIPs? I mean, you just said we can start with a 500 rupee investment. So how can I invest? Who's a novice investor and really wants to get into ELSS scheme? How does he start initially with it?
Yeah, so SIP is definitely a very, very attractive and very popular way within this category, because keep in mind that equity markets tend to be very volatile, and SIPs allow you to take advantage of this volatility with something called cost averaging. So because you're not investing as a lump sum at one point in time where you may have some timing challenges, an SIP allows you to even out the investment right through the full year that you're planning to save for. And that, again, you can just save more regularly, therefore. And because of the cost advantage, it can therefore have far better outcomes for you. So certainly because it's a mutual fund product, you can start with an SIP of as low as 500 rupees. And of course, build it up to as much as you want. There are no maximums.
Is this the right time to really invest in an equity-linked savings scheme when the markets are at record high? There's a little skepticism among the people saying that markets are at record high. Would it be right to really invest into equity, something which is linked with equity?
Yeah. So I'll go back to the 2 points that I made earlier. Firstly, it's a free gift, so don't give it away. Please make the most of it. These are the few sections available where you can save some tax. So please make the most of it. The second is the objective was long-term savings, and therefore the entry point per se may be, when we look at entry points, we look at the very, very short term. We look at the market last week or a few months back, and then we compare it today and they say that, think that it has gone up. But think 5, 10, 20 years or even more, and then look back and say, look, did the entry point really matter? So if you've not as yet invested or completed the eligibility under Section 80C this year, please go ahead and do it as soon as possible. Now, for next year, I would suggest that start early and start an SIP for the full amount that you plan, which gives you the benefit of spreading it out right through the year. So you don't have to wait for the last minute rush and worry about timing or any such issues like cash flows, because it is planned and invested right through the year.
So what are the options available under ELSS scheme? I mean, do we have options like growth and dividend options?
Yes, most funds do offer growth and dividend options. So should you need the benefit of dividends coming back, you can certainly avail of that. But having said that, in most cases, since your objective is long-term, corpus building, and that's why I keep going back to the objective, it may be useful, and it is certainly more tax beneficial also to keep it to the growth plan currently. So, by taking away money and the part of the gains early, you're not giving that part of the corpus the benefit of long-term compounding. So unless you really need the dividend to support your cash flow, I would encourage that you should look at the growth plan, but both are available.
How should one really build a balanced portfolio which takes care of your tax planning needs also, and which helps in wealth creation too?
So I think the ELSS product, I think beautifully sits in this space, because like I mentioned, it is listed as one of the instruments available for you under Section 80C, and therefore you can invest up to 1,50,000 and benefit from tax, gains, the tax concessions you get. Of course, you can always invest more than that as well, because in itself, it's a equity-linked, mutual fund product. And, you have great track record available now, and you can see that many funds have done enormously well in creating and generating wealth for you. So like any other equity allocation, this can certainly sit in that bucket of equity allocation through mutual funds for you, with the added benefit of tax. So this is a beautiful sweet spot that you have with this product.
So if we talk about the year 2020, it has been a very tough year for everybody. And now people, they don't want to get into mutual funds directly. They say it is better to invest directly into stock markets and not going through mutual funds. Is this the right thinking that is now prevailing in the market?
So I'm not sure, whether an individual investor would have or would want to get into the rigor of selecting stocks and doing the amount of analysis that a professional fund management team does for you, and in the long term come up with as good or similar results. So while of course people may want to dabble with stocks, and sometimes you can get lucky as well with the rising market. Keep in mind, it's relatively luckier or easier to get lucky. In the long term, one has to look at it and say that firstly, do I have the skill and the time to do this on a full-time basis? And when you measure performance objectively, as a fund manager does, and it is highly regulated as well, so it is very consistent. Do I really think I can beat the performance of fund managers over the long term? And third is, of course, how much does it cost? And as you go through, you'll realize that the all-in cost of all the effort and all the convenience that you get to a mutual fund may not be really that significant versus your own time and effort that you will take in going through this process. So certainly for me, I would prefer to go through a fund any day for some of those reasons. I may not be able to diversify my portfolio, run it that rigorously, and have all the tools and techniques available that professional fund managers will have to be able to generate the type of positive returns over benchmarks that a fund manager could do over a long term.
Key things that one should keep in mind while considering investing in an equity-linked savings scheme. How should one choose the right product?
So for the right product, there are many attributes of a scheme or a fund house that come into play. It's a fairly involved topic, but certainly you would want to look at whether the asset class itself is meeting your requirement, and within that asset class, what is the type of scheme. Keep in mind that there are many categories of schemes available even within asset classes like equity and debt. So which category of scheme make the most sense? Then within that, which is the fund house or which is the specific scheme, and how much allocation to each of these. Often it is seen that because this is a fairly evolved decision, it may help to have a distributor or an advisor working with you for this. And certainly for your customers, if you have the benefit of ICICI Securities helping you through a lot of the data and research that you would have access to, then use it as productively as possible. Keep in mind that therefore that choice of asset and to some extent the allocation can be a big determinant in the long-term performance of your portfolio. And using someone to discuss that with or help you with is always a good idea.
How would you see this last minute getting into investment into tax saving instruments? Because most of the people, when March approaches, say that, okay, I have to get into some kind of a tax planning. How would you see this, and what would you suggest people and the investors in such circumstances?
So I would say, look, it happens to all of us. We relegate some of these very important decisions. We tend to sort of procrastinate and relegate it to the last minute. And, everything to do with tax has to be done somehow in March. And that's how for many salaried people, that's when the companies come back and ask some information. And then you have to make up your mind and give the submissions and all of these. Having said that, do try next year, if you haven't done so this year, to actually use this year's experience and plan it better for next. And the simplest way is that that this is an option available. Just plan your ATC upfront, the benefit under ATC upfront. And if you've chosen an ELSS product, which I hope you have, spread that across an SIP and you're done. So getting that done on in early April is a far better way to look at doing this now once again in March 2022 or February 2022. That has significant benefits, so don't give up on this benefit unnecessarily. It takes lesser time to do it in April 21 rather than in March 22.
Thank you, Mr. Kapoor, for being with us and sharing your views. It was a pleasure speaking with you.
My pleasure. Thank you for having me.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.